Hello, this is Michael Stokes. I wanted to talk with you today about active versus passive management. This is very important in terms of your overall rate of return, your investment costs, and your opportunity to capture true market rates of return. Most investors don't even know or realize that there's a choice to be made about how markets work and what they believe. Without this knowledge, it's very easy to be manipulated by outside sources. So what is active management? Well, the ability to predict future market changes and mispricing in order to capture increased rates of return. In other words, by actively managing and trading equities, it will bring greater control and better returns. Active management claims that when they do capture these better rate of returns, they will pass them on to you, the investor. Passive management, on the other hand, means that no one can consistently predict the future of market pricings and movements. Notice I emphasized and underlined the word consistently. There will be managers and individuals who beat the market every year, but as we shall see, it's much tougher to repeat the performance. The passive management or market works belief system says that markets are random and unpredictable, and that they quickly reflect new information and knowledge as it becomes available. The efficient market hypothesis implies that no active investor will consistently beat the market over long periods of time, except by chance. Yet active managers test the hypothesis every day through their efforts to pick stocks in time markets. The evidence shows that their efforts are not worth the high cost borne by investors. This slide displays the percentage of actively managed public equity funds that failed to outperform their respective market benchmarks for each major fund category for the 5-year period ending June 2009. None of the fund categories beat its index as a group, and 4 of the 7 categories had at least a 70% failure rate. The emerging markets manager category on the right-hand side had a 90% failure rate. This is consistent with research, which shows that as a group, active managers underperform the market by an amount equivalent to their average fees and expenses. Research by Eugene Fama and other financial academics has offered evidence that the bond markets are efficient and that interest rates and bond prices do not move predictably. This appears to be the case with all types of issues, from short-term government instruments to long-term corporate bonds. This slide illustrates the formidable challenge that active bond managers face. The graph shows the percentage of active fixed income funds in each category that failed to beat their respective market benchmark over the 5-year period, again ending June 2009. 5 of the 8 fund categories had at least a 90% failure rate, and all of the categories had at least a 70% failure rate, with failure again defined as underperforming their benchmark. This again is consistent with financial theory and research, which propose that active managers cannot outperform the market as a group, particularly after accounting for management fees, trading costs, and other expenses. Market efficiency is a major reason why actively managed fixed income securities and strategies do not outperform their respective benchmarks. Investors who want to capture market returns in the fixed income universe may be hard-pressed to identify an active strategy that shows any long-term promise of success. Thanks for watching this video on active versus passive management. If you would like to see how this idea can work for you, please contact us here at the office.